Hi, I'm Joe Elsasser. I'm president of Covisum. Covisum is the software company that brought you Social Security timing and now tax clarity. Today, our focus will be on tax clarity, on practical uses for tax clarity. I'm also a practicing financial advisor, so these things that we'll talk about are things that we're doing in our local practice here in Omaha day in and day out, both to attract new clients as well as to retain existing clients and position for referrals. So really there are four key focus areas today. First is that initial prospecting. How do you use tax clarity to prospect for clients? Second, are there unique ways to approach CPA relationships or potential center of influence referrals using tax clarity? Third, the end of year review. How do you use tax clarity to add value to those end of year reviews that you're doing for clients? That's kind of that October 15th timeline. And then finally, the April 15th timeline. What are those things that you should be checking for heading into April 15th of each year for your clients? So the real question, what do you look for on a tax map? Do you go left, do you go right, or do you not go at all? Those are really the big questions. When you look at a tax map, you've got those choices. Go left, go right, or don't go at all. But before we get there, I want to review a couple of key elements of the bracket structure, or the way the tax map works. There really is an important feature of the tax brackets that is most often overlooked by lots and lots of advisors out there, and that's the 0% capital gains bracket. Remember, for purposes of this presentation, that extends up to the top of the 15% ordinary income bracket. I'm going to show you why that's relevant, but keep in mind that 0% tax bracket is there. Now, with capital gains though, it doesn't just extend to the number. So if our 2016 tax bracket went up to $75,300, and each year those increase. So don't focus so much on the number as you do focus on the bracket. If it's $75,300 in 2016, we can't just harvest $75,300 of capital gains and expect them to come through regardless of whether we have ordinary income on the return or not. It's really important to remember that the ordinary income that we have on the return impacts whether or not the capital gains are going to be taxable or not. The second thing to remember is that it's ordinary income plus capital gains determine the bracket. They're not distinct brackets. So if we had $75,300 of taxable ordinary income, and I say that specifically, taxable ordinary income, we would not be able to harvest any capital gains at 0%. If, on the other hand, we had $75,300 of taxable capital gains, that's it. We can't continue to harvest, even though our ordinary income bracket would still be 10% for $1 of ordinary income that we might harvest. And I'll show you that here in an example. So some key questions are whether the client was with another advisor, maybe the other advisor missed an opportunity. We're going to be able to expose that using the tax map. So let's dig into a case study. This is a go left case study, and it's prior to April 15th. So this is really after we've finished a calendar year. We're sometime between January 1st and April 15th. And now we've got really the specifics of all the income that hit the household. So we've got John, who was born in 1949. He's retired. He's doing part-time work and only earning about $6,000 a year. Maybe he's working at a golf course, he's getting a bunch of free golf, and not working too many hours. He's taking a monthly systematic IRA withdrawal for an additional $30,000 per year. So in the ordinary income column for John, we've basically got $3,000 a month. Now we've got Jane. She was born in 1956, and she earns $56,000 per year. Let's say Jane had an employee stock purchase plan, but she's gotten to the point where she's got over 10% concentration in that stock purchase plan, so it's time to sell some of that stock. So last year we sold $25,000 of employee stock. We want to monitor this situation in order to try to get as much of the capital gain through at a 0% rate as possible. And this time frame between January 1st and April 15th is the key time frame to do that. So here's how we enter it in tax clarity. You see, we add up all the earned income and we put that in the earned income column. We've got $36,000 in the IRA distributions column. And they had $14,623 of that $25,000. That's how much of it was actual capital gain. So those are our inputs for tax clarity. Now let's take a look at the tax map. You notice they're falling directly on top of that gray box. So they're falling outside the range where the only thing we have to care about are the bracket structure. What we have going on whenever we're landing on a gray box is an interaction between two different types of income on the return. So in this case, you see that 30% next to the total on the ordinary income tax map there. What that means is that each additional dollar of IRA withdrawal or each additional dollar of earned income, or on the flip side, each contribution to an IRA, that's going to have a 30% impact on the client, not just the 15% impact. And the reason is because only part of their capital gains are taxable. So when I take an extra dollar of IRA withdrawal, what happens? Well, taking that extra dollar of IRA subjects the IRA withdrawal to a 15% tax for ordinary income, but it also pushes a capital gain dollar that would have otherwise come through at the 0% rate up into the 15% rate. So the net impact of taking an extra dollar out of an IRA for this couple is a 30% effective marginal rate. Remember that phrase, effective marginal rate. Now, on the flip side of the coin, if I contribute a dollar to an IRA, I'm lowering the amount of ordinary income that shows up on the return. So I'm not just saving the dollar that goes into the IRA, I'm not just saving the tax on that dollar, I'm also dragging a dollar of capital gains that would have been taxed at 15% back down into that 0% range. So this is a real case that happened to me just this spring. Had a situation where we had a CPA, fantastic CPA, he's great in a lot of ways, know him personally. And when the client called him, he said, no, there's probably not a reason to do an IRA contribution because you're only in the 15% bracket. He wasn't seeing the interaction with the capital gains. So when we brought that to his attention, worked together to determine the amount that should be contributed to the IRA, Tax Clarity gave us a really close estimate. He was able to refine it a little bit and set that relationship on a great foot. So here's what it ended up looking like. Ended up contributing over $10,000 to an IRA for the company. And what we notice is the tax goes down by 30%. That's the effective marginal rate change. So if you look over here, how much falls into the 0% long-term capital gains bracket? In the first case, that's on the left-hand side, we had $71,000 of ordinary income, 0% capital gains, $4,000 fell in there. On the second column, you see that the taxable ordinary income after deductions and exemptions went down to $60,000. And so we actually got $14,000 of capital gains through, the entire capital gain through at the 0% rate. So it was a $10,750 contribution. The question then became how much to his IRA and how much to hers. So this is a situation where interactions can go considerably deeper than we as financial advisors are often prepared for. This is why it makes a ton of sense to go out and use Tax Clarity to, one, open the conversation with CPAs, but two, also use it as a triage tool. So me as the advisor, I'm going to do a quick pass through Tax Clarity with the client. If it looks like there are opportunities, I'm going to work with their CPA to validate those opportunities. It reinforces their relationship with the CPA. Potentially, it gives the CPA billable hours, and it adds a lot of value for the client. So in this case, because Jane was contributing to an employer-sponsored retirement plan, she could only contribute $4,000 to a deductible IRA, $4,020, which means that we contributed a $6,500 max to his IRA in order to get us to the number we needed to reduce those capital gains as much as possible. Now, Tax Clarity isn't going to be able to tell you those limits for contributions. It's not asking about outside contributions to IRAs. That's where it becomes so important to build relationships with other centers of influence in your local market. So here's a second case study. This is what we might call a go right case study. We've got John and Jane. They're both 64. They retired at 62. Jane started taking her Social Security benefit early. She gets $9,000 per year. John's going to be delaying his own benefit until 70. He wants to get that survivor benefit as large as possible, and he's going to be taking a restricted application, so filing only spousal benefits based on Jane's earnings beginning when he turns 66 in 2 years. Now they have $700,000 in a non-qualified investment account. That includes 2 highly appreciated mutual funds. Maybe those transferred in from a prior advisor. and they've got 80,000 capital gains in those two mutual funds. They've got $600,000 in his IRA and $200 in her IRA. And their lifestyle's only $50,000 per year. So you probably have clients like this, I know we do in our local book, where basically the reason they've accumulated so much money in savings is not because they'll need it, it's because that's how they've always lived. They've always lived below their means. And so the likelihood of them ever running out of assets during their lifetime is very small. When we look at the tax map, there should be a couple of things that jump out at you right away. First, you notice on the ordinary income, they're down there at $7,000. There's quite a bit of ordinary income they could harvest before a single dime became taxable. So we know right away that if they're not doing something, they're wasting some space in that tax bracket, in the 0%, or they're wasting their standard deduction and personal exemptions. Now, if we did a Roth conversion, that's one thing that we could do, is we could convert part of the traditional IRA into Roth. And we'd pay zero federal income tax so long as we don't exceed that taxable range that's listed out there. So in this case, let's say we did a $67,000 Roth conversion. We took them all the way up to the edge of the 15% bracket. Now, you notice they're sitting on the edge, not of the 15% bracket, they're sitting on the edge of a 30% range. That's the point where their capital gains start becoming taxable also. And so we don't want to go all the way into that range. We want to go to the edge of their effective marginal rate of 15%, because otherwise they're basically paying a penalty that they probably weren't aware of, and that penalty is dragging some other capital gains into the return. So in this situation, we added $67,000 of ordinary income, or IRA withdrawal, in order to do a conversion over to the Roth IRA. The additional tax on that's going to be a little over $8,000. So basically we're going to pay an average tax rate over that $67,000 of only 12%. We can kind of think of this as the first do no harm Roth conversion, or the idea that I'm going to convert only until the point that I reach an effective marginal tax rate that is higher than what I would otherwise pay if I didn't do anything, if I just waited till R&Ds started hitting. And so that spot is 15%. We don't want to fill the full 15% bracket. We want to go right just far enough to where we're at the edge of the 15% effective marginal rate. So we can see we did create a little bit of taxable Social Security, but right now, for the next 2 years, her Social Security is the only one that's on the return. So that's a trade-off worth making. Now, the other way we could go right is by harvesting some of those capital gains in the legacy positions. Remember, if we do nothing, if we just let their portfolio be, they've got $7,000 of ordinary income on their return. If we went ahead and harvested those capital gains, and we pulled out an extra $67,500 of capital gains, that brings us right to the edge of when we start seeing some capital gains. So what ends up happening is we harvest a good chunk of those at 0%. We actually are able to harvest about $75,000 of capital gains without paying any federal income tax. That's all falling in that 0% capital gains tax bracket. So either way, we could do some Roth conversions, or we could harvest and get out of those legacy positions that maybe they're not holding because they want to hold, they're just holding because they're scared of the tax bill. Two good paths for taking advantage of a 0% tax rate on at least part of the money. So how do you make the decision? Do I do an extra IRA withdrawal or a Roth conversion, or do I harvest the capital? The real questions are these. First, I've got to consider the non-qualified holdings. Are they being held only to avoid tax? If they are, it goes back to that idea, we don't let the tax tail wag the investment dog. So we're only holding them to avoid the tax. Now, the second question is, are they going to hold them for the rest of their life? Because if we were holding them because they're a great investment, and the expectation is that we will hold them for the rest of the client's life, then they would get a step up in basis. And because they get a step up in basis, that tax burden would disappear at death anyway. So we don't want to harvest them if we know that they're expected to hold them to the end of their lifetime. Third, do they make charitable gifts? What a great strategy to gift appreciated securities. If you haven't looked into donor-advised funds, we've got a lot of clients who use donor-advised funds because they were already going to make a a gift to a charity, but that allows us some flexibility in being able to accelerate future gifts up to this year and be able to get out of some of those legacy positions when it makes sense to do so. And then finally, we want to consider the eventual required minimum distribution. If the client has saved far more in their IRAs than they'll ever need to support their lifestyle, what we have to realize is when those RMDs start being forced out of the account, they're going to be paying tax on those. And oftentimes, it's going to push them up into a tax bracket that's much higher than they would otherwise be in. So if we can accelerate some of the withdrawals out of the IRA, that'll reduce the RMD later on, and as a result, it'll levelize their tax bracket over their lifetime, keep them from jumping later into a much higher tax bracket. So those are the big considerations when we're determining whether to harvest the extra money from the IRA, whether by Roth conversion or whether just by pulling it out and using it in another way, or whether we should go ahead and harvest some capital gains at a 0% tax rate. So if I were to put together a few easy flags, what are some things that I should look for right away on a tax return? Here might be a few of those. First off, you're looking at a tax return and you see some taxable capital gains, but not all of the capital gains are taxable. Do a tax map. That's going to give you a good idea as to how much you can contribute to an IRA and get that double whammy of savings in capital gains tax as well as savings in IRA. So that's a real big positive. The second is look for any low basis, high value holdings in the non-qualified account. And if they have low basis, high value holdings, then you've got to ask, why are we holding that? Are we holding it because we're scared of the capital gain, or are we holding it because it's a good investment? If it's just because you're scared of the capital gain, look for opportunities to harvest at that 0% rate. Next, look to see if they have taxable Social Security. Some of the most common places you see spikes on a tax map is when $1 of IRA withdrawal or IRA contribution influences whether 85 cents of a Social Security dollar will be treated as taxable or not. So if they have taxable Social Security, run a tax map and see if you can have that impact of being able to pull part of that Social Security back into non-taxable range. On second thought, ask your CPA relationships. Ask every single one of your CPA relationships whether they have any clients who are paying $0 in federal income tax and have IRA accounts. You'll probably be surprised. They'll probably smile and they'll say, of course I do. Say, well, have you ever thought maybe they should be harvesting a little bit more from the IRA, especially because they'll eventually have minimum distributions? Or if they don't spend it during their lifetime, their kids are probably going to pay tax on it. You ever thought about maybe having them spend a little more early in retirement, at least to max out the 0, but possibly to max out the 10% bracket? Surprisingly enough, most CPAs are focused on higher net worth clients, so they're not paying attention to those opportunities, but oftentimes those can be great referral opportunities for us as financial advisors. Next, do they have earned income? Remember, they've got to have some earned income, whether it's his or hers on a married return, in order to make an IRA contribution. If they have earned income, it doesn't matter whose name it's in. So if the Mr. in the couple has the earned income, but the Mrs. hasn't contributed to an IRA, you can certainly contribute a contributory IRA on her behalf. And so that's a rule that a lot of advisors are unfamiliar with. So if you're not familiar with that, as long as you have some earned income, odds are better than not that they'll be able to contribute to an IRA. And then finally, evaluate that future required minimum distribution. If it's way more when combined with their Social Security and other guaranteed income sources than they need, if it's way more than they need out in the future, then it probably makes some sense to harvest a little bit more of that soon. So let's talk about some marketing ideas. Really, we just talked about some techniques. Should I go left or should I go right when I look at a tax map? Now, there are some really easy marketing ideas. You don't ask for CPA meetings during their deadline time. So if you're not familiar with what the important deadlines are for CPAs, it's March 15th, that's corporate tax, and April 15th, that's personal tax. Those are the initial deadlines. But a lot of them are filing extensions, so that's an additional 6 months on an automatic extension. That's September 15th and October 15th. So if you're going to call on CPAs and you do it right around that time, be prepared to alienate the relationship and never get to talk to them again. Here's my suggestion. Do it in the summertime. That's their slow time. It's their slowest time of the year. Always request tax returns from all clients at annual reviews. It gives you such a great opportunity to have that conversation with the CPA. It's also going to have their contact information on it. So that's a really natural introduction for you to make to that CPA. Definitely send an initial letter to the CPA before you reach out and call him. Hi, we have a joint client in John Smith. I'll be calling in the next few weeks to introduce myself, but if you have any questions about any of their accounts as you're preparing their returns, please feel free to give me a call. And then finally, when you make that follow-up call to the CPA, definitely mention the client name and have the client suggest an initial meeting with the CPA. In our practice, we use a little intro letter for all those CPA relationships that basically covers all of those things. We also send over a copy of an authorization so that they know that we have the client's permission to talk to them about relevant matters. Now, a second idea is doing a continuing professional education event. Again, stay away from those deadline times, but we've found November to be a decent time frame and late summer to be a decent time frame for these CPE events. Of course, CPAs have to get continuing professional education, just like many other professions. Lawyers get CLE, continuing legal education. Now, finally, right inside the Tax Clarity software, once you're outside the free trial, once you've paid for the software, you can go to the settings page, and down at the bottom right of the settings page, you're actually going to see a link to download a PowerPoint presentation. This is our FINRA reviewed consumer presentation that you're able to deliver. I've been delivering the Tax Clarity seminars in our library series for the last several years here in Omaha. It's a great complement to the other things that we're doing around Social Security, around overall income planning, estate planning, Medicare. Those are all parts of our series. The Tax Clarity seminar presentation is there. It's available for any subscriber to use to do seminars in their local market, and it's FINRA reviewed. So that's available to you once you're a subscriber to the software. Thanks so much for taking this quick practical walkthrough, both of the tools and a couple of different ways to use the tools, and then also how to communicate that message out in your marketplace to be effective in growing your business. We look forward to working with you.